those were the jobs that were lost, close to 130,000 versus 208,000 that were gained, mainly in the hospitality and retail. So what that's telling me is you can't just look at the base number. It's telling me the types of jobs that are added are those second and third jobs that don't have benefits, that are lower paying because people cannot afford to take care of their bills.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, hey, what can you say about these job numbers, man? We're living in the best of all possible worlds. We should be grateful that the economy is being stewarded so well by so many responsible politicians in the United States and throughout the world. But consumer credit continues to boom. What does it mean? We got Eddie Seidel with us now, EGSI Financial. Eddie, great to have you back on the show. So we should be excited about these job numbers, huh? Because that means more interest rate increases coming down the pike.
Well, first of all, thanks for having me back. And you know what? It all depends on how you interpret the data. First of all, if you listen to what Biden said, he added 13 million new jobs since he started as president. So, that by itself says, rates got to keep going up because we have a thriving economy. However, when you look at the jobs that were added, the types of jobs versus the types of jobs that were lost during that exact same time period, I mean, we went from, manufacturing and IT and financial services and education and healthcare. Those were the jobs that were lost, close to, 130,000 versus 208,000 that were gained, mainly in the hospitality and retail. So what that's telling me is you can't just look at the base number. It's telling me the types of jobs that are added are those second and third jobs that don't have benefits, that are lower paying because people cannot afford to take care of their bills, which leads right into, the consumer credit, where we hit new historical highs. I think we're over $1.25 trillion in credit card debt right now. Defaults are up, month over month, quarter over quarter, year over year. So, I think this may be what the feds are looking at to say, maybe we can take a pause.
All right, perhaps. So, yeah, obviously more Uber drivers, more bartenders. At one time, I remember a few years ago, new hires of wait staff and bartenders were driving the economy forward, right?
Yeah, you're absolutely right. And it's the same thing, it almost seems like out of sheer will, the consumer, the American consumer, we're kind of spending our way out of this. But, there also seems to be a huge disparity between the haves and the have-nots. Those that have in working class middle America, they're really struggling. And you can tell when you're looking at the not just what's being added on the revolving credit cards, the credit card debt, but the amount of defaults. I mean, it's gone up almost 1% just over the last year from the end of 2021 through the first quarter of this year. So those are, again, it all depends on how you look at and interpret the data. And what that's telling me right now is that the economy may not be as strong as what people are touting it to be. Again, depending on how Powell and the feds look at it, it may be enough to say, we may take a pause or at least skip, take a pause and maybe, increase it in July. But I think a lot is going to depend on the CPI that comes out this week.
All right. So what's your take on the CPI as long as we're talking about it?
You know what? Inflation is still here. I think it's going to be maybe a little bit lower than what's expected. And people get very excited about that hey, it's getting lower. But remember, it's compounding year over year. That's what that means. It's compounding year after year after year. So, when the inflation that we're seeing right now we're not going to see the effects of this for months to come, just like with the rates. I mean, we raised rates 500 basis points in a little over a year, and we're just now seeing the effects of that rate raise, from last fall right now. And so, what happened earlier this year, we're not going to see those effects until the, middle to late fall of this year. So are we going to be in a recession? Are we already in a rolling recession? It remains to be seen. Honestly, I really thought by now that we would be in a recession, or at least pushing towards it, going into the third quarter. But again, out of sheer will, I don't know. I really am shocked that the economy is still pushing forward the way that it is.
Hey, it's like that old trusty, reliable Model T Ford, built around the turn of the last century, and with enough chewing gum and bobby pins and paper clips, you can keep that baby running forever, right?
Yeah, exactly. And and here's the other thing, that's just to touch on this. The S&P for the first time, actually got out of bear territory and was officially a bull market last week. Mm-hmm. And when you look at the Nasdaq, it's really strong, but it's so narrow. It's a very narrow market. You've got 7 companies in the Nasdaq that are really driving it, again, that are skewing the numbers. And then when you look at the S&P, it's less than 20 companies out of the S&P 500 that are really pushing that up this year. So it's a very narrow market, which makes me nervous from an economic standpoint, from a market recovery standpoint, even though it's a leading, indicator for the economy. The last time we kind of saw this was, right before the tech bubble. So, I think I think it's important to be cautiously optimistic, all the way around, but, cautious is the operative word.
Caution is the operative word for sure. And so things aren't as bad as they could be, but how good are they really?
That's exactly it. Yep. That's a great point. And it really, depending on what the feds do, it could put us in a tailspin from an economic standpoint. If Ballard really does push forward and say, hey, we're going to hold true, and we're going to raise rates and make sure that inflation doesn't come roaring back. That could kind of crush the economy going forward. If they raise it a couple more times, I don't think that they will. I think in the back of their minds, they're looking at all the data and saying, okay, it's starting to work. I don't think they're going to lower rates anytime soon, and if at all, it'll be in 2024. But again, having that impact, as we start to see loans coming due, commercial real estate, over, $1 trillion coming due just this year, I think, this is going to continue to see negative impact on the economy going forward.
Okay. So happy days maybe aren't here so much, huh?
Again, I'm not sure yet. I don't think that they are. I was talking to a colleague of mine, and he said, now's the time really to start selling off into the rally. And I'm not sure I agree with that either. I think, if you have cash on hand, keep cash on hand and really hedge, on everything that you're doing from an investment standpoint, and really look to those areas that have struggled over the last year. And even currently, manufacturing, energy, utilities, that have really taken a hard hit as of late, because as things get a little rougher, those are going to be the things that really are going to hold true, especially if those companies are value companies with strong balance sheets. Because I do think a lot of the tech companies are, way overvalued, multiples way higher than what they should be.
All right. So do you think is going to be a come to Jesus moment here with these valuations, Eddie, or are we just going to continue on? The old saying, the market can remain irrational longer than you can remain solvent.
Actually, I was just getting ready to say that. And that's the whole thing. I mean, out of sheer will, there's a lot of things that from a dollars and cents fundamental standpoint that aren't making sense, and out of sheer will, it may just push through it. We've seen it before, but I don't know. I'm really cautious. I'm hedging a little bit, in those sectors that we talked about. Those companies that we have that are strong balance sheet type companies, value stocks, we're not getting rid of, but we're not willing to redeploy a whole lot more capital right now until we really see what's going on. We're being, again, cautious, operative word.
For good reason too, right? Caution is the buzzword, right? So
absolutely.
How cautious? Like, what does your portfolio look like now?
So depending on the client, we're anywhere from 20 to as much as 40% in the market, and the rest is either in cash and in money markets, FDIC insured. And those that are have the appetite and can afford to take a little bit more risk, and have more of those value stocks. We bought in a little bit during the dips. But those that are close to or at retirement, I think it's, why risk what you have for something you don't need, right? I mean, just, take a pause, be a little cautious. And, if you're getting 5% in a money market right now, why take the risk? We've got enough in there so that if the market really is a bull market, we can take advantage of it and start to redeploy that capital back in. But if it does tank, then we're protected on the downside as well.
All right. Well, I think you've given us a lot to chew over here, Eddie. We appreciate you coming on as always. Just tell us where we find you these days.
EGSIfinancial.com. That's the best place to find us.
All right. And that link is in the show notes on financialsurvivalnetwork.com. Make sure when you go there, you sign up for a free newsletter. Got one coming out, a big one this week. Really appreciate it. As always, Eddie, you be well. Talk to you soon.
All right. You too, Kerry. Thanks for having me.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.